Welcome to BTFDtv. My name is Jack Barnes, and the one, the only Chess is with us today. Uncle Bob is going to be joining us for comedy side moments. Chess, I want to turn the camera over to you and say thank you for joining us, and let's pick up that conversation we were having in the green room and introduce the crowd to what you were thinking. Thank you.
Thanks, Jack. It's always great to be on with you and Bob. Basically, the analogy I was drawing about the market that we've seen, I guess we're in football season now, and baseball's coming up with the pennant, but I'll draw the analogy to what they say if you're a sports fan about the NBA, basketball, or the NHL hockey in playoffs. You usually have these best-of-7 playoff series, right? And you have one team that has the home court advantage, so maybe they get the first 2 games in their arena, and then it goes back and forth. But if there's a game 7, if there's a tiebreaker, it's always, of course, in the team with the home court advantage. And so what happens is, by definition, if you have home court advantage, as long as you win every game on your home court, you can lose the games, away games, and you'll still win in the end, right? You'll still win the war. You might lose a couple battles here and there. And I think the analogy was, in this bull market, the last couple years, I mean, bulls have always held home court advantage, like, without question, right? So each of these little minor victories bears might have been able to get on a general, I think, as a general proposition. I mean, looking at it for the forest, for the trees, all they were really doing, bears were, in terms of equities, was just winning maybe a game here or there on their own home court. But they never really won a game. They never really wrestled the home court advantage away from the bulls, right? So you never really had a real fight on our hands. It was always kind of this one-way market, and that was reflected, I think, in the way equities were. The S&P went several years without testing its 200-day moving average till last October. The S&P went several years until recently without, coming in 10%, that kind of thing. And I think what happened in late August was bears actually won a game on the Bulls' home court. And I think that was, I think, for the first time in probably since 2011, we saw that. And I think that is what's causing now this fight that we have on our hands, this day-to-day battle, because we have, what they say in sports is when the away team, there's an old phrase that a playoff series, let's say in basketball in the NBA, it doesn't really start until the visiting team actually wins a game on the home team's court, because otherwise, again, by definition, if the home team just wins on their home court, then they win the series, right? So we don't really have a series, or we don't really have a fight on our hands in the market, a real fight, until the Bears had won a game on the Bulls' home court. And I think my point in saying this whole convoluted example is that I think that's part of the psychology we're seeing on a day-to-day basis, with the market going back and forth and the randomness of the price action, overnight gaps, up, down, zig, zag. There doesn't seem to be much rhyme or reason, and I think that's really what's taking place. Is we have a series, we have a fight on our hands. We actually now have a series on our hands in the market, and there's a lot at stake. Because I've been saying in my videos, I mean, you have plenty of tens of trillions of market cap and all that on the line here, looking out as to whether this bull market is really, in the final inning or so, or is it ready to be put to rest, or is this just going to be another pause that refreshes it? And because there's so much on the line, especially this time around with the S&P 500 index trading well below now, a declining 200-day moving average, that's a difficult circumstance technically after a multi-year bull run. I think we have a series on our hands. We have a market on our hands. That's what I want to start the video off with.
Agreed there. One other thing I mean, what we've seen is tremendous price movements intraday, which has really confounded a lot of people that look at the markets. I mean, me as well. I mean, I've moved to a little bit slower pace of trades, but I heard a very prominent guy who's on Twitter, Sell Puts, who you both probably know, really complain about the lack of trends, that there are no trends. Any thoughts on that?
Yeah, I mean, I do think when you see a market that's trying to decide where it wants to go next, I mean, you have the struggle, like where bulls and bears are. I mean, really what's happening is, I think psychologically, and I know there's a lot of talk about the algos and HFT and all that, but the reality is, I mean, the market's still the market, I would say, overall. And I think what's happening here is you're having not a quiet, benign disagreement or consolidation like you tend to see in bull trends. You're seeing a loud, violent disagreement between buyers and sellers arguing about, price discovery, whether stocks are. I mean, Bill Ackman came on TV, I think, this morning and disagreed with David Tepper. Ackman said stocks are pretty cheap. Tepper said, well, and Tepper, of course, known for being a legendary bull at times. And he's saying, well, I'm not so sure stocks are really cheap, and like you have this disagreement taking place all over the place. And I think that's what yields, I think the net result is this price action. I think it's a function of trying to decide where the next directional move is coming. But in the meantime, I mean, for example, look at commodities. I mean, head fakes galore, but deflationary forces still could very much be in play. Goldman, I think, had that $20 a barrel target on crude or something like that.
Yeah, they put that out today. Well, at least to the public today.
Yeah, and so the easiest thing would be to say is, well, that's a fade, right? Goldman calling for $20 a barrel, but then you look at the price action, and crude, crude's still struggling. I mean, crude is not exactly off to the races, cementing that Goldman was a contrarian, buy signal or anything like that. So it's a I guess you guys have that guy Muck Bear on here. This market's kind of in the muck, so to speak, for lack of a better phrase.
Indeed. Well, did you want to talk about any specific areas, anything in particular that you've been looking at that's given you some tells? I mean, if you want to talk about the commodities more, we'd love to hear certainly some of that.
Well, I think in terms of last time I was on, Bob, I think it was it was right in the midst, I would say, of that Black Monday. The kind of the quasi flash crash, that kind of August 24th of this year. And then when I was on before with Jack in late July, the main thing I was looking for was if this classic bifurcation in the market in equities would play out. And I think it is so far. What that means is you have really, really strong parts of the market which have been acting beautifully, I'd say, in recent years. Healthcare, biotech, a lot of liquid growth titles like Netflix's and Amazon's and that kind of thing. And then you have really, really weak parts of the market: energy, transports. I mean, even semiconductors to a degree. And so the issue, emerging markets. And so the issue then became, you're always going to have winners and losers in market capitalism, right? But when you have classic bifurcation, it means the spread or the divergence between the winners and the losers is so wide. It's such an extreme circumstance that it basically denotes that the market lost its discipline in some respects, because you had everyone piling and flying into the obvious winners in biotech and healthcare, and there's no disputing the underlying bull thesis to healthcare and biotech and some of these big glamorous names in the NASDAQ. But at a certain point, you have to ask yourself how the market is a discounting mechanism by nature. So how much good stuff, how much of that bull thesis has been effectively discounted? And the other side of the coin, with the really weak parts of the market, the XLE, and I'm looking at this chart now. The XLE can't even hold a rally yet above its 20-day simple moving average, and it hasn't been able to hold a rally above it since I want to say April of this year, which is really incredible because that's a very fairly short-term reference point. And so what that means is you had really, really strong parts of the market that most market players piled into. Then you have really, really weak parts of the market, not just winners and losers, extreme bifurcation, and then everyone kind of left.
Just look at my basket of holdings.
Yeah, they have really weak parts which were left for dead by the side of the road, and even bargain hunters who step into the XLE looking for bargains in these big energy stocks. It's going to take time. If there is a bottom here, it's probably going to take some time to play out, and we might go down and make new lows and retest and all that really unsexy, decidedly not glamorous parts of the way markets work. So really, really strong parts, really, really weak parts. And if you look throughout history to kind of make this a little more tangible, what usually happens is the strongest parts eventually break, and then the weak parts kind of kind of stay weak, and maybe Netflix is cracking a little bit, but look at Umbrella, AMBA, look at GoPro, look at Mobileye. I mean, even a name like Krispy Kreme, which is not, market leader, but still, it had a nice momentum run up. Lululemon, some names like Taser, which was a great momentum name, at a minimum cooled off, definitely suffered some down. I mean, it's definitely not a generous market. And then you take a look at names like Twitter and Yelp and those kinds of names. You would think bargain hunters would be stepping in by now, even for mergers and acquisitions, but it's just not happening. I mean, the weak names are by and large staying pretty weak. And, if emerging markets and some of these plays are so badly beaten down, I mean, why haven't we seen a day where the XLE, like we've seen in plenty of prior bear markets, why haven't we seen a day where the XLE, the energy sector ETF, has been up 10% in one day or something to that effect? We really haven't seen it. I mean, that happens in bear markets where you get these absurd rallies, and we haven't even seen enough. We haven't seen enough buying power or willingness to cover shorts to do that. So I mean, I think that's a big concern going forward. This whole bifurcation issue might be playing out, but in the meantime, it's obviously a narrow market, and the day-to-day movements are definitely picking up in terms of the randomness of the price action. And if this is the final third or the final inning of this bull market, Paul Tudor Jones had that famous quote that, basically he was just trying to say there's nothing you can really do in this kind of a market other than play great defense, preserve your capital and confidence. I mean, all those, really grind, that kind of the other side that I think people envision life as a speculator or as a gambler, not the kind of, the sexy midweek trips to Las Vegas and all these great nightclub parties. Not that. I mean, the real grinding, that kind of disciplined part of speculation and gambling. That's, I think, what this market really necessitates more than anything else. So.
Yeah, I mean, I think your point is so well taken with regard to energy. I mean, I had started once ExxonMobil came off from, I don't know what their high was, maybe 94 or something in the order of that, but it got down to the mid 70s. And in a long-term account where I was full of cash, I just started kind of accumulating it. Then it went down, I think, as far as 70 or 71 certainly, and then it popped. And you know what? I just honestly I didn't feel comfortable with it. Now there's a tremendously strong company
Sure.
With a great balance sheet, with lots of real cash on hand.
Yes.
And yet they can't seem to get out of their way. Any thoughts?
Yeah, I think it might not be so much an issue of ExxonMobil. I mean, so that's where you get into the whole philosophy of value investing and that kind of thing. And I think value investing probably requires an extreme amount of patience in its own right and discipline, in the sense that I think you can acknowledge that, yes, ExxonMobil does represent some value. I mean, I don't dispute that. What I come from is a position where the macro forces and the momentum forces, maybe deflation, maybe just the whole bear market of energy in general, can take it down to an absurd level. I mean, we saw that in 2008. We saw stocks at absurd levels in some respect, right? But if you were a value investor back in 2008, you could have made the same arguments well before that bear market had ended, well before we saw the October 2008 crash, right? So it requires, I think, as a value investor, what you're essentially saying is you're pointing at the market and you're saying the market is misjudging, is making making some bad decisions, and you're taking advantage of it. So that inherently requires, I think, some humility on the part of the value investor, that you have to allocate. I think you have to space out buys. What I'm trying to say, you have to leave yourself a lot of wiggle room. I think there's a lot of things that value investors don't. I'm not talking to you, Bob. I'm just in general.
No, I hear you and I'm listening.
I think value investors often, because in some respects it stands in stark contrast to technical analysis, is that they tend to almost castigate all facets of technical analysis and almost by proxy risk management, because really technical analysis for me is not voodoo. It's not magic. It's not going to give me any kind of holy grail. Occasionally, it'll yield, a really great, call or whatever, that kind of thing. But for the most part, what it does is help you define risk. I mean, that's really what it does. It gives you some parameters. And I think what happens with value investors is they often say, well, look, there's no way that ExxonMobil, currently trading at 72.31 spot price, there's no way Exxon can ever go into the 40s or the 30s. So it's not going to happen. So therefore, I'm going to start a position here, and I'm going to build all the way down to 60. You hear that a lot, right? And then you get down to 60, and we're in some huge macro, unwind or something with, and all of a sudden it goes down to 40, and then, you know what I mean? And I think you have to account for that. You'd be remiss not to at least account for it in your process. I mean, that's all I'm saying. To cavalierly dismiss the idea that some of these energy, I mean, because saying that Exxon can't go into the 50s or 40s is to disregard the fact that Exxon, since the 1980s, has been, adjusted for splits and everything. In 1984, Exxon was trading with a 5 handle. Okay, so now, do I think it's going back there? No, I don't think it's going back into the single digits. But what I do think is that Exxon has seen a brilliant multi-decade run, and there's no telling that now that it's finally going downhill a little bit. There's no telling. There's no. It doesn't need to respect any given level just because it may represent a great value on paper, right? Because there's momentum cuts both ways, and I think a lot of people are looking at Exxon, and I am too, and saying, well, look, you get a dividend, you get the cash, everything you said, Bob, right? If we see Armageddon, Exxon is probably going to be one of those companies that's going to last until the very end or something, right?
Yeah, it should.
But that still wouldn't preclude, a move that maybe kind of scares the living daylights out of bottom fishers before we arrive at a true bottom. If you could, just for one example, if you're any of you out there looking at your long-term charts, that mid-50s area, the mid-50s in Exxon was a huge area of support going back to 2005, over the last decade. So, would it be absurd? It sounds absurd. Exxon's trading at 72 right now. For Exxon to go into the mid-50s, yeah, that would be a painful move lower. And I'm not predicting it, but I would say you'd be remiss not to at least consider it.
Absolutely. One more thing, one last thing, and then I'll shut up and I'll turn it over to my partner here. The other thing I wanted you to speak about and get your thoughts on was the impact of Apple on the overall markets, and that is not only on the equity markets, but also on the bond market. Obviously, it's been talked about in every period, every publication. Everybody talks about how much cash is sitting around, sloshing around at Apple. But anybody, even the most casual of stock watchers, can notice as Apple moves during the day, whether it ticks up or ticks down, it tends to take the markets with it. I'd just like to get your just general thoughts on that before I turn it over to my partner.
Yeah, I think there could be something said for that. Apple is definitely a widely owned, widely loved stock, and for good reasons. It's obviously, they put out great products and all that. They have, brand loyalty. All that fun stuff. But when you look at the chart of Apple, what's interesting, to your point, Bob, is Apple was, just like the S&P 500 index, was in this sideways range from February this year until summer. But I think the difference between Apple and the S&P was Apple actually broke down below its range after its late July earnings report. It broke down below it on heavy sell volume, and then the S&P actually followed suit a couple weeks later. So there might be something to what you're saying, that maybe Apple still, and I'll be the first, about a year ago, I didn't think Apple was a market leader anymore. I thought Apple had already started its morphing or its metamorphosis into one of these mature techs, like Microsoft, Oracle, that kind of thing. I thought Apple would succumb to the law of large numbers. I was wrong on that point. Apple kept growing, and it's obviously still, I would say, a glamorous kind of market name. A lot of people are still obviously in the name and love the name, and again, for good reason. But that point about Apple breaking down below its range on heavy sell volume a couple weeks before the S&P did, because they had very similar charts at one point, the sideways ranges.
Right.
That might be a good tell here that Apple not only is still very much relevant, but maybe even kind of out in front of the market. And as we're looking now, Apple, it's trading around 113 after its product announcement this week. It really hasn't made too much headway one way or the other since that. Could have, if it bounces up to 120, I think that would be a really, really big level there. I think that would be a difficult level. And if it breaks down from here, I do immediately, into next week, we might, this whole market analysis that we're talking about here, it may very well be just like the big buildup or the prologue in front of the Fed next week, of course, right? But if Apple breaks down here, let's say below 110, 109, especially 105, I don't think, I have to think that will put a lot of pressure on the broad market is what I'm getting at. So
right.
I agree with what you're saying, Bob. Yeah.
Yeah, I think if that happens, for people that are listening and that listen after we're done here, I think you would be remiss if you didn't have Apple on your screen. Whatever your holdings are, whatever your targets are, potential targets are, if you don't have Apple on your screen and you're not watching that in light of the market, I think you're really missing something. Just my thought.
Yeah.
But anyway,
I don't disagree.
Anyway, at this point, I'll just turn over to Jack, who I know has some questions.
Hey, been a while. I got a couple in the old portfolio that have definitely not been the leaders of alpha. And obviously the worst trade I've put on lately was my refining basket. So let's take a look at a couple of the refiners and just see what your thoughts are of them now. The crack spreads are coming in,
yes,
but the prices are also dropping significantly. So it's, what does the tapes tell you? Let's look at Tesoro.
Yeah.
I'm down 12% on that one. So let's take a look at that one.
The refiners were looking really, really good over the summer. In July and August, they were clearly outperforming the market. I think when I was on with you, Jack, in late July, I gave this analogy that the refiners are kind of like that little small clique of almost like greasers in high school, right? They got their hair slicked back, they're smoking cigarettes. They do whatever they want, is my point. The refiners. I've seen them over the years. They would make moves so oblivious. They're so aloof to, to what the market's doing at times. But since that move higher in early to mid-August, it was a very, very swift rejection, I would say, of this idea that, Tesoro would break over 110 or even hold over 100. So there was definitely some consternation there with Tesoro TSO, and there might be a risk that it's forming a head and shoulders top, some kind of topping pattern since July. It's not confirmed. I would say, Jack, if TSO loses 90 and especially 86 again, that to me would be a big warning sign that it could easily be going much lower. For now, it kind of looks like a lot of charts in the market where it could be topping out. It could be the pause that refreshes. We kind of need a little bit more information. But when you back out the chart of Tesoro since 2009, since the bear market bottom, you got to remember, Tesoro was trading in the single digits at one point. The Tim Geithner low, right, of November 21st, 2008, Tesoro traded at $6.71 a share. Can you believe that? And now it recently traded, 110 over the summer, $110 a share. So, with that, my point in telling you that is, again, this idea that could Tesoro go? I hate to sound like one of these, boom, gloom, and doom guys, but you have to just put it into context. The forest for the trees. When you have a stock that's gone from 6 to 110, would have moved down to 80 or maybe 70. Would it really be the end of the world would it be the end of a multi-decade bull trend? Not necessarily, but it could, it could be a little bit, I would say, of pain.
All right, take a look at its sister Valero, and then the final one is Marathon, because I put a basket on.
Yeah, I mean, I think Valero's in the same spot as Tesoro. Has not broken. I mean, these still have, from a technical perspective, Tesoro, Valero, they still have rising 200-day moving averages. So, all this, downside target talk is still premature until we see sellers, if we see sellers make another push. But Valero, similar kind of look, I would say, to Tesoro. I think a lot is riding on that 57 area, Jack, below 50, because 57 is that 200-day moving average. That's where buyers kind of stake their claim in late August. Just like with Valero around the upper, that 88 area, the 86 area. That's around Tesoro. That's where buyers kind of stake their claim in Tesoro, 88, 86, and then with Valero, they kind of stake their claim around 57, right? So I think it's a good level against which to trade, is my point. And now Marathon, MRO, that was the other one you said, Jack?
Yeah.
Yeah,
that's the one that caused the movement in the other two when it did a big deal.
That's right.
It was the horse that pulled the cart on those three.
Yeah, I mean, I think that's an issue because Marathon is clearly the weakest of those charts. It's below a declining 200-day moving average. It's in a strong downtrend. And this is a good example, Jack, of bifurcation within a sector where you've had some runaway monsters over the summer, what looked like. I mean, Tesoro, at one point, when it hit 110, looked like, the next top momentum stock, right? And while that was happening, Marathon was sinking into the abyss. So that's bifurcation, really, really strong, really, really weak. And so Marathon, to what your point, what you were saying.
Irony because of timing.
Yeah.
I'm actually up. I'm down the least. That's a better way of putting it. I'm down the least on Marathon. I was able to catch the spike and then the collapse. So there's an odd timing event where the damage in mine is less in Marathon and most in Tesoro.
Okay.
Let's move to another one. We'll move to a totally different topic. And I'm going to run through I have no problem admitting to the whoopses that come along in life. So NetEase, that's a tech company that does the massive online gains and stuff out of China. So you have the China damage happening to it. However, it has been just a monster stock priorly. So thoughts on that? It's collapsed now, obviously.
Yeah, in some respects it has collapsed, but then you look at a weekly chart going back to 2012, it's still, it still hasn't really. I mean, I would say if NetEase here, if it loses, 102.80, and especially lose longer term, it starts to lose 94, something like that, then I would say, okay, this uptrend since 2012 has been effectively reversed. I would say for now, maybe the bull case that you illustrated, Jack, the bull case would be that NetEase just kind of got caught up in this whole China liquidation, right? This whole China selling event. But it's going to come out on the other side like reasonably well, because the reality is in 2012, this is why I like to look at long-term charts. In late 2012, NetEase was trading at $37 a share. Recently, in July of this year, it traded about $154 a share, something like that. So that's a lot of price appreciation, the last couple of years. And so the bull case is that again, this is pretty much all she wrote on the pullback. It went from 150 down below 100. Yeah, I mean, that's a pretty aggressive shakeout, but longer term, maybe it's still in this uptrend. So that's what I'm getting at here is we have a series on our hands. I mean, to go back to the analogy at the top of the video, we have a series on our hands, and I think you have to be extra careful in light of the multi-year bull trend that we've seen, because there's a lot on the line here. If you're just assuming that we go back to new highs, that can happen. It's happened before, but it's like a rubber band. The further out you stretch it, the more likely it is to eventually break, right? So I think that's the danger here. So I think there's a lot on the line. That's my point.
All right. So just so that everyone knows that I'm just that there is other things in the portfolio. Let me just put it that way. Let's take a look at Newlink Genetics Corp. So we're over in the healthcare category, biotech. Newlink is actually my best performer since June.
Sure.
So what are your thoughts on it? Because it seems to have survived, and I'm green, double digits still, even after the.
My thoughts are absolutely. I mean, Jack, my thoughts are this. I mean, I think in every market correction, even in 2008, maybe especially in 2008, I think it's part of your my opinion is it's part of your due diligence as a trader, as an investor, to keep a running and updated and fresh list. And this is what we do inside Market Chess Subscription Services. I mean, we keep it running, updated list of what's known as relative strength names which are holding up well, which are exuding relative strength maybe to their peers and to the market at large. And in this way, whenever, I mean, that goes to the idea of humility I was talking about with value investors. Whenever the market does show signs of at least stabilizing, that it stopped going down, you're left with a cogent and focused and updated and fresh list, which you've been refining this whole time. Even on the ugliest of down days, you still put in that extra, could be a couple minutes, could be an hour, to update that list of relative strength names. And then this way you're left with names which should do well when the market does turn back up with a little more conviction. And why do I say that? Because they weathered the storm very well, and that kind of implies that either A, sellers just weren't that interested, or B, there are definitely interested buyers with strong hands willing to support these stocks even in the ugliest of broad market conditions. And I think Newlink, to circle back here, I mean, it's still acting reasonably well. I mean, if you look above 55, I think it could be an upside breakout candidate. It's in biotech. There are definitely some, as always in biotech, the last couple of years, there's going to be some nice hidden gems. And I think Newlink qualifies as relative strength names, one of them to keep on the watch list. I mean, you take a look at a name like Panera in the casual dining space, not bad. I mean, I'm sorry, not Buffalo Wild Wings. BWLD, I mean, it had a nice run up to new highs of late. BWLD, and then you take a look in the healthcare space as well. I mean, Supernus, SUPN. I mean, these are names which I would qualify as not bad. I mean, you take a look at the firearms plays, Ruger, RGR, and Smith & Wesson, SWHC. Again, I think they would qualify as, acting reasonably well, even pretty well, in what had been some really brutal market conditions the last couple weeks.
All right. How about Facebook?
Yeah, I mean, Facebook falls into the category to me of like Google, Tesla at the current moment, Amazon. I mean, these are leading, even though Netflix has come under the gun the last couple of weeks, even though some biotechs like Biogen and some of the other ones have come under the gun in recent weeks, you still have a collection of generals in the Army, a collection of leaders here, which, I mean, there's really nothing inherently wrong, I would say. I mean, yeah, Facebook on August 24th, like everything else in the days leading up to it, suffered a really heavy sell volume, kind of not a particularly orderly selling event. But since then, it's kind of wedged back up. It's still got a rising 200-day moving average. It would only be if skid marks. I'm sorry?
We used to call those skid marks. And they're usually left by someone who, well, they had to get out of there pretty damn quickly.
Yes, definitely. I mean, it would only be, Jack, if Facebook now rolls back over. Again, I mean, you could argue the setup there. I know plenty of bears that would look at this Facebook chart and say, look, it's a rising wedge. You got to short it. But I think jumping the gun prematurely has been punished many times, especially shorting in this market of late in the last couple of years. And so you would need to see at least, I mean, and Facebook is, I would describe it as like, a high beta kind of growth name. So you can get hurt badly on the short side more than shorting like a big liquid stodgy name, like a Home Depot or something, right?
Speaking of which, that was my next symbol was Home Depot has strength right now.
Okay. Well, okay, let me just say Facebook, I think it's in a holding pattern here. There's nothing wrong with the chart overall. It would only be if it heads back down off this 50-day moving average right here at spot price. That's, I think, would be a little more cause for concern. Home Depot has, again, had those skid marks, like you said, in late August. It's had a great run the last couple of years. This was another one. I thought it was an abnormally steep trend, and I was just wrong too early, whatever you want to call it. I still think it's a very, very steep trend for a market cap of this size. and I think the monthly candle that it printed in the month of August, and I think the quarterly candle it's printing right now, as we know the third quarter of trading ends the end of this month, September. I think these kinds of candles that it's printing, they're just huge in size. They denote a lot of indecision after a steep multi-year uptrend, Jack. So even though it's holding in well here, I mean, I don't think Home Depot is a great buy opportunity. I haven't thought that for a while, though. But I do think the risk, that goes to the rubber band theory here with Home Depot. I mean, I do think the risk that it'll finally kind of come in, I think, is high. I mean, we saw that with Union. Home Depot reminds me of the way Union Pacific, UNP, the big railroad was back in late 2014. That's the analogy I would draw technically. And Home Depot, Union Pacific has definitely come in, and now it's a glaring laggard. So.
All right. Well, I've ran through my list.
Well, I mean, that gets to the idea of bifurcation, right? Really, really strong, steep trend. How long can they go on for when all these other parts of the market are struggling a little bit? You know.
Uncle Bob, do you have any questions?
Well, you know, I probably have one or two I could come up with, but I just wanted to pass it over to you, Chess. And you know, I know that last time one of the items we discussed, because they were going through an interesting metamorphosis, and what you thought may be happening was it may be that these two were identified as those survivors in the coal industry, and that was ACI and BTU. Any thoughts on those?
Yeah, I mean, I think what happened was, and I updated this for member, and on the blog, I think I did a blog post, was what kind of threw cold water on all of that, for me at least. I was watching them, and that Arch Coal rally was really promising in August, but the kind of the party pooper was Joy Global, right? The big coal machinery play, and they took a shellacking earlier this month after earnings, and the fact that they got sold that hard on that heavy volume, even though Joy has already been in a really steep downtrend, even though it's already covered a lot of ground to the downside the last couple of years, that to me was a sign that I shouldn't get too cute trying to declare multi-year winners or multi-year bottoms in the coal industry. That there might be some more, there might be like a grand finale to this horror film, right? Where like the guy comes back with the chainsaw and the Halloween mask.
I love the analogy because I think I mean that's essentially what has happened in the coal industry. I mean it has absolutely been obliterated, and I saw a number of people. I can't recall who they were because I do read a lot of different things, but talk about how they thought, well, that's a bottoming pattern, and obviously it hasn't played out. Now there's kind of renewed, they have found some previous owners, I guess.
Yeah, I mean, you almost have to catch yourself in the moment and have this like self-awareness because again, it's very easy to get caught up, and when you start seeing Arch acting the way it did, even BTU just a couple days ago looked like a really nice bull. I mean, if you look at the BTU Peabody Energy chart back on last Friday, a week ago, even Monday morning of this week, it looked beautiful, but in terms of a quick long trade. But when you have that's why I talk about this. When you have a declining 200-day moving average above price, that's the market's way of telling you all is not necessarily well. That we have a downtrend, and then you can see Peabody gave up the ghost and then some. And again, just to circle back, since I'm doing all these analogies today, it's almost like I'm sure you guys saw that movie Scream. I guess it was 20 years ago now. The movie Scream, the parody of horror movies, and it's almost like when you say that phrase, "I'll be right back," right? Like they do in horror movies. And then of course that's always the guy who goes off, and then the guy with the chainsaw gets him. And I think you almost have to catch yourself. And I think if you were declaring Peabody and Arch Coal to be the survivor, that they're definitely bottoming on a long-term investment. You got to buy them. You're almost like that guy that's saying, I'll be right back. I mean, you're kind of putting yourself at risk, especially with Joy. So my tell now is Joy Global. If Joy Global can put in any kind of discerning bottoming pattern or anything like that, I would have a little more, I would think, evidence to at least take a shot. So.
No, that's an excellent point. One other item that I wanted to touch on, and I know that you have addressed in your blog posts and such, is Ford and GM. And Ford, just came off a monster quarter, really a great quarter, right? And saw pop, but boy, that pop seemed to be faded to me.
Yeah, I mean, you'd say Ford and GM are still pinned below all these moving averages, and I think Ford is an interesting case because it's like the all-American company, right? Henry Ford, and then Mullally, and everything like that, and the great turnaround. And I know a lot of guys personally who are serious stock traders who've told me privately that they'll never be able to bring themselves to short Ford because it's, un-American, or just because they love the trucks or whatever. And I think that it's an interesting case, but technically Ford is below all moving averages, and it's below a declining 200-day moving average, and that's a problem. I mean, and then if we look at the chart, I mean, look where it was. I think it was earlier this month on Wednesday, September 2nd. That's when those great sales came out. We closed the day at 1387, and spot price is 1362. So it's not like that was some panacea or anything close to it to kind of rectify the technicals that Ford's having. And it's not just Ford and GM, Bob. I mean, I know they have Macau exposure, but Steve Wynn, ticker symbol WYNN, right, Wynn Resorts, is down another 3% today. It's been in this devastating, unforgiving downtrend, okay? And I know they have Macau exposure. I'm fully aware of China and Macau. But still, I mean, if either of you guys have stayed at a Wynn property, I mean, he's a terrific businessman. I mean, he's a great casino operator. And to see a stock, I mean, go from hero to GOAT. I mean, Wynn was trading 250 almost, I think, in early 2014, and now it's 67. To see a stock take this kind of pounding, it's obviously, I think, the centerpiece in many respects of Las Vegas for high-end resorts, and that's a problem. I mean, I think that's a signal. It's not just that, but when you look back at the multi-year chart of Wynn Resorts is well below its 2007 and 2011 peaks, so it kind of gave up that breakout it had in 2013, 2014. That's a problem, and I think my view, I mean, just from the way in which the market's acting here, is that it could be something more ominous than just Macau. I mean, you can't. The easiest thing, if you think back and take a step back, how many people do you know just dismiss everything as, oh, well, that's Macau, right? That's a Macau thing. Well, what if doesn't that sound a lot like, oh, well, that's a subprime thing. That's a subprime loan thing, right? But maybe it's not just a Macau thing, I mean, that's something to consider. I mean, this is a high-end or aspirational high-end name of prominence, just like Sotheby's, just like Tiffany. I mean, you know what I mean? So
are you saying that Macau is contained or Macau is not contained?
The fundamentals of Macau are strong. How do you like that, Jack?
All right, that'll work.
Tiffany, Sotheby's. There's some issues out there that might just be more than Macau. So.
All right. On that note, we've been going for about 45 minutes. Do you have anything that you would like to touch that we haven't brought up in prior conversations?
No, I mean, I would just say I think it's very important to stay balanced. I mean, I said this last time. I think these kinds of markets, it's very important to stay balanced psychologically. I mean, there's a whole mental game of trading and speculation, and that's why I meant the whole idea of putting in the work to update a list of relative strength names so, you're not caught out of – I think those traders who were caught in these kinds of markets leaning too heavily – I mean, my opinion is we're not yet – in high conviction kind of market where it's correct to be necessarily pushing the envelope. Remains. I mean, if we do see another swift leg down in the market at large and some damage in names like Amazon and the biotechs and Google and Facebook, then I think that would probably add credence to the bear case, in terms of entering a new regime and a new cycle down. But otherwise, I mean, again, I think it's important to have that balance. I mean, I think you can take your shots, but I mean, it's a high-risk market. I'm not so sure it's a high-reward market. I think that right there should probably compel most traders out there to reduce position sizing. And I mean, there is something to be said for keeping your own equilibrium, I think, emotionally and mentally as a trader. And I think you can see it in social media. You get days where emotions are running really, really rampant, and then you get days where everyone's just kind of quiet and burnt out, right, from the action. And so the idea is to avoid that kind of emotional roller coaster. I think it'll serve you much better, I think, over the long run.
Thanks, Chess.
Thanks, guys. Great being on with you.
Thank you, everyone, for catching this episode of BTFDtv with Chess on the Markets. We'll be back again, and Uncle Bob and I are going to be rolling out the old macro table again on Sundays. So join us there, and we look forward to talking to you guys again during the fall. On behalf of Uncle Bob and I, Uncle Bob, yes, go ahead.
One more quick thing. I have gotten commitments from a number of folks who are very smart people. So we're going to be rolling those shows out on a go-forward basis too. Whether they will be regulars or not, I'm not sure, but we will keep everybody apprised. So keep an eye on our tweet stream for sure.
All right, thank you. And on behalf of BTFDtv, my name is Jack Barnes. Have a great evening.